Welcome to Types of Life Insurance. My name's Glenn Cook and I'm the term guy. In this video, we're going to look at what differentiates the different types of life insurance in Canada and figure out what's the best one for us. But before we do that, just a couple of quick points, a couple of product types we're going to get right out of the consideration here. The first one is you should only ever look at life insurance where the premiums and the coverage amount are fully guaranteed. If either one of those is not fully guaranteed, it's probably not appropriate for you, particularly given the long time frames we're looking at with life insurance. Secondly, some insurance types have investment options. We're purchasing life insurance to protect our family's income and therefore our lifestyle in the event of our premature death. That's got nothing to do with investments. If you start looking at investments within your life insurance, it's first of all probably not a good investment. RSPs and TFSAs are much better. And secondly, it's going to distract us and lead us to getting the wrong type. So we're not going to look at policies that aren't fully guaranteed, and we're not going to look at policies that have investment options here because they're erroneous and not really what we're looking at here. So let me give you an example. Let's say you purchase $1 million of a good type of life insurance and I purchase $1 million of a bad type of life insurance, and we both pass away. So what's your family get? Well, your family gets a check for $1 million. And what's my family get? Also a check for $1 million. You can't tell what type of life insurance you had by looking at the product we're purchasing, which is a death claim check in the event of our death. Your family got $1 million, my family got $1 million. So when we look at the insurance portion of what the product that we're buying, all life insurance is indistinguishable. It's all the same type. $500,000 of one type is the same as $500,000 of another type. So there's something else going on. It's not the insurance. We don't have good types or bad types. We simply have different ways of paying for them. So this is very similar to if everybody's purchasing the same car, but you have three ways of paying for it. You can lease it, you can pay it outright, or you can take out a car loan. That's what we're going to do, is play around with different premium structures over long periods of time to give us the different types of life insurance. Now, if we take the pure form of life insurance, the premiums have to go up every year as we get older. That's pretty clear to everybody. It's cheap when you're young and more expensive when we're older. So costs go up in a big swooping curve. This type of life insurance, if you purchased it, would be called 1-year term insurance because it's going up every single 1 year. But that product isn't palatable to a consumer that's buying insurance over 10, 20, or 30 years. We don't want to see premiums that are going up every year. So what we can do is if we have a 10-year time frame that we need insurance for and then we're done, instead of paying the insurance premiums over the next 10 years in an increasing fashion, we can just total up those total costs, divide by 10, and end up with an average. And if we pay the average over the next 10 years, then we've paid the same total cost. We've paid all of our life insurance premiums. We've just paid for them differently. We've paid them level over 10 years instead of going up. Level premiums for 10 years, that's 10-year term life insurance, which is readily available in the marketplace. That's the definition of 10-year term, level premiums for 10 years. Now, I could do the same thing for 20 years. I could take this increasing cost of insurance, look at ages 40 to 60, add up those total premiums, divide it by 20, and now charge you the level premium over the next 20 years. That's 20-year term. And in a nutshell, that's term life insurance. So term life insurance has premiums that are level for a defined and specific period of time. Now, the second type of life insurance is called permanent insurance. All we're going to do is take this increasing cost of insurance, and instead of leveling out the premiums over 10 years or 20 years or 30 years, we're going to level it out over your entire lifetime. So we end up with life insurance where the premiums are level for your entire life. We're not going to drill down on that type of insurance because for most of us, that's not the type of insurance we're buying. And why is that? It's because when we're looking at life insurance to protect our income, how long do we need that coverage for? Because we want the cheapest over how long we need the coverage for. Well, if you're recalling the last video, we looked at covering our income roughly until retirement. And what happens at retirement? We don't have an income. Therefore, we're assuming that we probably don't need the life insurance anymore. If that's the case, we have a defined time frame for the insurance. We have an endpoint, which is going to be around retirement. And if we have an endpoint, we've got a defined period of time, and the correct solution to that is term life insurance. It's going to be cheaper over a defined time frame. Now, what type of term should you get? Well, typically we want to try and take your current age till roughly retirement, take that number of years, and get a term that best matches that. So if you're looking at it from age 40 to 65, the first choice in your term would typically be a 25-year term. If you're 35, looking at age 65, then you might look at a 30-year term. Now, there's one further consideration in your choice here, and that is marketplace conditions. In the marketplace, all different terms are available. You can get a 13-year or a 27-year term or what have you. But in practice, 10-year term, 20-year term, and 30-year term are extremely aggressively priced. So for most consumers, what we'll do is we'll look at the time frame till retirement, and then we'll try and match as close as we can either a 10-year term or a 20-year or a 30-year term. Those are the three types of term insurance that most consumers will end up looking at. Now, two more quick considerations. The first one is, if you need insurance for 20 years, we can get a 20-year term from say ages 40 to 60, or we could get a 10-year term now, which will be cheaper than a 20-year, from age 40 to 50, and at age 50, purchase a new 10-year term at our now age 50 and pay those premiums level for the next 10 years. There's a huge problem with doing that with that second strategy. We've introduced a lot of risk into the equation here. So when you purchase a 20-year term, you take one medical exam at the beginning of the policy, and that locks in your premiums based upon that health class for your entire 20 years. If you get a 10-year term, your health class is only locked in for 10 years. At the end of 10 years, you've got to requalify and take a new medical exam for the new insurance policy, and we don't know if you can do that, and if you can't, bad things happen. Therefore, if you need insurance for 20 years, get a 20-year term. If you need it for 30 years, get a 30-year term. Don't be stacking shorter terms, because now you've got to be taking medical exams as you get older, and as you can imagine, that's a bad thing. Lastly, we now are at the point where we can start running quotes, and quotes actually make sense. We've got a good idea, we've got a good handle on how much insurance we need, we've got a really good handle on the type we need. Go start running some quotes, getting some numbers going here. Now, what you're going to do then, of course, is compare the premiums that come up versus what your perceived budget is. Now, the good news is that in most cases, the right amount and the right type is affordable for most Canadian families. Nobody wants to pay the premiums, but it is affordable. The premiums tend to be appropriate for the amount of coverage in your age. But once in a while, we end up in a situation where we say, okay, the premiums are going to be $75 a month, and that's just not in the budget. So what do I do? Well, what do? You need $1 million of term 20. The premiums come up at $75 a month, and you don't have the budget for it. You're not prepared to spend $75 a month. And the answer most consumers do immediately is, instead of getting $1 million, they'll chop it down to $500,000. And let me tell you, that's the wrong answer, because you have just locked in the wrong amount of coverage. And if you die tomorrow and your family needed $1 million, but you only purchased $500,000, we don't have enough insurance to fix the job we're trying to fix, which is look after our family, not for a long enough period of time. So the correct answer to, if you're trying to fit coverage and policy types to budget, cut the policy type first. If you're looking at a 30-year term, drop to a 20-year term. If you're looking at a 20-year term, drop to a 10-year term to save on budget. That way, if you pass away tomorrow, again, nobody cares if you had a 10 or 20-year term, they only care about the $1 million. Now, there's still a problem you have to fix. At some point, you've got to figure out what the budget is and then use the exchange option to jump up to the 20-year term. Or in 10 years, you're looking at passing a medical exam. None of those are perfect, but that's a better trade-off than getting the incorrect amount of life insurance.